$75,000. That's how much one couple lost to a Medicare trap they didn't know existed, just because they sold their house in the wrong year. And here's what kills me: they did everything else right. They talked to their financial advisor, the estate attorney, and the family. They were supportive. They even got the right real estate agent to get them a good price on their home. But nobody, not their agent, not their financial advisor, warned them about what happens when you spike your income in a Medicare year. If you're thinking about downsizing in your 60s, or you're helping a parent navigate this very transition, you need to know where the money traps are hiding. Because most families, they focus on the real estate transaction and completely miss the wealth implications. Someone asked me recently, and I'm going to read this. It was, Weldon, we're planning to downsize next year when we turn 65. We've talked to a financial advisor and our kids and an estate attorney, but I keep feeling like there's something we're missing. What should we be asking that we're not? They've already talked to a financial advisor, the estate attorney, and the family is on board. That's good. But here's the problem: that's not the complete team. Those people don't usually coordinate with each other. And the gaps between them, that's where expensive mistakes hide. That $75,000 Medicare trap that I mentioned, that is completely avoidable if someone had connected the dots. Today, I'm going to show you the 5 financial mistakes families make when downsizing and exactly what questions to ask before you sign anything. So starting with mistake number 1, and that's not understanding your capital gains exposures, even with the exclusion. Most people, they've heard about capital gains exclusions. Okay, so if you're married and you live in your home for at least 2 of the last 5 years, you could exclude up to $500,000 of gains for taxes. And of course, we're talking about your primary residence. Now, for single filers, though, it's $250,000. But here's where families get burned. If you bought your house in 1985 for $80,000 and it's now worth $650,000, your gain is $570,000. Married couple? Okay, right. We use that $500,000 known exclusion, but that remaining $70,000, that's taxable. And depending on your income, that could mean anywhere from $10,500 to $16,000 on federal taxes that you weren't expecting. But here's the bigger issue: that gain gets added to your income for the year, which affects everything from your Medicare premiums to whether your Social Security gets taxed. The question to ask your CPA: based on our expected sale price and the original basis, what's our capital gains exposure and how does that affect our total picture for the year? Write that question down, okay? Pause this video and write that down because you want to ask that purposeful question. A quick sidebar: I've sat across the table from enough families who are going through these transitions to know exactly where these traps are hiding. And more importantly, I've watched what happens when no one coordinates the timing. It's not pretty. So what I bring isn't just real estate knowledge, it's project management discipline applied to life transitions. I help you connect the dots between your CPA, your estate attorney, your certified financial planner, and your real estate timeline and strategy. Because when those conversations happen in silos, that's when mistakes get expensive. Moving on to mistake number 2, the Medicare IRMA trap. This is the $75,000 mistake that I mentioned. IRMA stands for the Income Related Monthly Adjustment Amount. It's a surcharge on your Medicare Part B and Part D. Those premiums, they're based on your income from 2 years ago. And here's how it works. So Medicare, they're going to look at your modified adjusted gross income, your MAGI, from, again, 2 years prior. And if you sell your house in 2025, Medicare is going to look at your 2025 income, but not until 2027. And if your income crosses certain thresholds, your premiums can skyrocket. Now, standard Medicare Part B premium, that's around $175 a month. But if your income spikes into the highest IRMA bracket, you could be paying $594 a month. That's $420 extra per person. For a couple, that's $840 extra per month for 2 years. Now let's do the math. $840 times 24 months is over $20,000. If you have Part D as well, add another $50,000 or more over 2 years. That's $75,000 that I mentioned. Real family, real trap. No one warned them. Now, I know this feels overwhelming. There's a lot of numbers flying around. Take a breath. The point isn't to memorize all of this. The point is to know that these traps exist so you can take and ask the right questions before you sell. The question to ask is, what year should we sell to minimize Medicare premium increases given our current income and the 2-year look back? Sometimes selling in December versus January, that can give you a full year of IRMA surcharges. Timing matters, but you got to coordinate with your CPA. All right, mistake number 3, this is not coordinating with your estate plan. This one's a little more complicated, so stay with me because when you get it right, it can keep a meaningful amount of money in your family. So the Johnson family, they actually booked a call, watched after watching one of my downsizing videos. They were planning to sell their home for $500,000 and buy a smaller place for $320,000. Simple downsizing conceptually, but here's what we uncovered. We looked at the full picture, and their home was owned outright in their personal names. No trust, no estate plan. And here's the key idea in plain English. If mom and dad pass away while they still own a long-time home, the IRS, they're going to oftentimes reset the home's value for tax purposes. That can mean their kids inherit it with a major tax advantage instead of inheriting decades of taxable gain. But if they sell the home first, the tax story changes. Any capital gains issues usually gets decided at the time of the sale, and buying a new home doesn't cancel that out. After the sale, the family is mostly passing down cash in a newer home that probably hasn't had much time to grow, so there's far less tax reset benefit left to capture later. Now, sometimes, and in fact, most of the time, selling is totally fine, and you should do it, especially if the home sale exclusion makes most or all of that gain tax free. But if your goal is to build long term legacy wealth, or at least get the snowball rolling for your family, optimizing it before you sell, that can make a huge difference. This is exactly where my life, wealth, real estate framework comes in. We start with the life decision first. Do you actually need to move? Then we optimize the wealth options around your long term goals. And only then do we choose the real estate move that supports the plan. In the Johnsons' case, we coordinated with an estate attorney before they sold. They structured ownership correctly, they used a trust in the right way for their situation, and avoided the common traps that accidentally create a tax bill. The end result was that they protected roughly $52,000 for their heirs. Here's the thing. I'm not a CPA or an estate attorney, and I can't give legal or tax advice, but I can tell you the questions to ask before you list. That's exactly what we talk about on a strategy call. Link, it's in the description below. But if you jump straight to selling your home by calling a real estate agent, these aren't conversations most agents are having. But if you care about keeping more wealth in your family and not losing it to avoidable friction, these are the conversations to have before you put a sign in the yard. Then once that is optimized, once your wealth decisions or options are optimized, then I can connect you with an agent that develops a strategy to complement your goals. All right, 2 more mistakes to go. Mistake number 4. That's ignoring the 5-year rule for your next home. So here's the scenario. I've seen it multiple times. Couple downsizes their home and moves into a condo or a townhome, and 3 years later, one spouse passes or health changes, and they need to move again. They move into assisted living or whatever works for their situation. Now, they're selling again, and the transaction costs, they are brutal. Between agent commissions, closing costs, moving expenses, and potential repairs, you're looking at 8 to 10% of the home's value every time you buy and sell. So on a $350,000 home, that's $28,000 to $35,000 gone. If you're likely to move again within 5 years, those transaction costs may wipe out any savings from downsizing in the first place. The question to ask yourself, honestly, can I realistically see myself in this next home for at least 5 years? What would have to change to make me move again? And here's permission that you might need. It's okay if the answer is, I don't know. That uncertainty is important information. Maybe you rent for a year first to test the location. Maybe you buy something with flexibility, a layout that works now and later. Maybe you wait. The point is to ask the question before you buy, not after. Now, mistake number five, that is prioritizing market timing over life timing. This might be the most important one, so stay with me. I get this question constantly. Should we wait for a better market to sell? And the honest answer is usually no. And here's why. The difference between a hot market and a normal market is maybe 5 to 8%. And while that's a meaningful amount of money, especially if you had a $500,000 home, that's 25 to 40,000. I get it. But waiting 2 years for better conditions, that has its own costs. The mental cost, the emotional cost, the reasons why you wanted to move in the first place, deferring that. Then you have the property taxes, the utilities, the home is too big or too complex, too much to maintain. 2 more years of not living where you want to live. 2 more years of physical and emotional energy spent on a property that doesn't fit your life. And honestly, 2 more years of uncertainty. If you're wondering if you're making the right choice, I've watched families wait for the perfect moment and miss their window. Dad's health declines suddenly. Mom can't manage the stairs anymore. What was going to be a strategic downsize becomes an emergency. Life timing beats market timing every single time. The question to ask is, if we wait, what are we actually waiting for? And if we do wait, what are we risking by waiting? So sometimes the answer, though, is we're waiting because we're scared. And that happens more often than not. And that's okay. Fear is a valid emotion, but name it, deal with it. Don't hide it behind the market analysis. So here's what I want you to take away. Downsizing isn't just a real estate transaction. It's a wealth event. And like any wealth event, it needs to be coordinated between your tax strategy, your Medicare timing, your estate plan, your life goals. Your real estate agent should also know and understand what you're going through so that way the strategy can complement that. And the families who do this well, they aren't the ones with the most money. They're the ones who ask the right questions before they signed anything. And here's the gift that you're giving yourself by doing this right. It's freedom. Not just financial freedom, though that matters, but the freedom of knowing you made this decision intentionally, that you didn't leave money on the table, that you protected your family. That peace of mind, you can't put a dollar value on it. Now, if you're thinking, okay, I understand Weldon, I get the financial side, but what about the emotional side? How do I actually get my family on board? That's exactly what I cover in my next video, how to emotionally prepare for downsizing. It's the family conversations, the decluttering process, the timeline that actually works. And I'll link it in the caption below. And if you want help mapping out your specific situation, here's how I work. Phase one, I'm the strategist. We identify your transition, we map the challenges, we separate the facts from the assumptions, and create a plan. Think of it like project management for your life transition. And then phase two, I'm going to prepare you for the wealth conversation. I give you the questions to ask your CPA about tax timing, the concepts to explore with your estate attorney about trusts and ownership, the strategies your certified financial planner should be running on your retirement projections. And then phase three, if and when real estate makes sense, I connect you with a values aligned agent. And if you're here in Colorado Springs, it'll be somebody on my team. If you're anywhere in the country, I make sure that that value alignment exists and that they can serve you and your need, and that that strategy complements your overall goals. I have a network of partners that I trust, people tailor-made for your specific situation. One call, 30 minutes, we figure out together where you are and what you actually need. Head to askweldonhobbs.com, book your transition strategy call. Let's build a plan that protects your wealth and fits your life. I'm Weldon Hobbs, project management professional, certified financial coach, Air Force Academy graduate, and transition strategist first, real estate professional second. Thanks for watching, and I'll see you in the next one.